What if I told you that everyday investors, people like you and me, are throwing away billions and billions of dollars? What is this guy talking about? Is it some kind of a tax? Nope. Average investors are wasting billions and billions of dollars on mutual funds. So, are mutual funds a scam? What even are mutual funds? And should we invest in them? First of all, mutual funds are professionally managed investment funds that pool money from many investors to purchase securities, and you pay fees in return for investment advice from a professional. These can be called active managers. Active managers actively select the best securities, for example, and they charge a percentage for that active management. And as we all know, investing can be confusing and intimidating, and so we'd figure that an active manager could help. But there are several problems with mutual funds. The main concern, and an important one, is that mutual funds overwhelmingly don't beat market averages. According to a study from the Wall Street Journal, between 71 and 93% of U.S. stock mutual funds either closed or failed to beat their closest index funds. So if we're being generous, only 30% of mutual funds can beat the market. If we're being generous. Another study was with Robert Arnott, the founder of Research Affiliates. He studied all 203 actively managed mutual funds with at least $100 million in assets, tracking their returns for 15 years from 1984 through 1998. He found that only 8 of these 203 funds actually beat the S&P 500 index. That's less than 4%. In other words, 96% of these actively managed funds failed to add any value at all over 15 years. So here's the thing with mutual funds. The data has shown over and over again that professionals aren't any better at predicting the markets than the rest of us. Not only that, but the fees are expensive. Active managers have to choose which stocks to buy or sell and when to buy or sell them. And so these funds have a high turnover rate. And who pays for all those brokerage fees? The client does in their fees. Also, these active managers are buying and selling very often. And so you pay short-term capital gains tax, which is also more expensive. So what is a better alternative to mutual funds? Index funds. An index fund is a portfolio constructed to match or track the components of a financial market index, such as the S&P 500. An index fund is said to provide broad market exposure, low operating expenses, and low portfolio turnover. They also provide survival of the fittest because the weak companies, or those that shrink out of the top 500 biggest companies, get replaced by better, growing companies. So companies fall in and out of the S&P 500, and the weak are replaced by strong. Index funds are a lot cheaper than actively managed funds, and the data shows they'll perform better as well. As we said, mutual funds charge a lot. The cost of owning a mutual fund is, on average, 2%. The cost of owning an index fund is 0.04%. That's right, 0.04%. That's like you going to Starbucks, your friend pays $4 for a cup of coffee, and you pay $250. Over time, that's a lot with compound interest. If the market returns 7% on average, the index will give 6.96% return after fees, and the mutual fund gives a 5% return after fees. Over the course of 1 year, that doesn't sound like much, but over 50 years, a dollar invested at 7% grows to $32. A dollar invested at 5% grows to $10. So you're putting up the same amount of money with the same amount of risk for only a third of the return. Yikes. But I know what you're thinking. Well, I can beat the market. Everybody wants to believe they can beat the market. They think most people can't, but I can. Well, consider the efficient market hypothesis, which says prices reflect all available information. And since prices reflect all available information, there's no way to beat the market. Now, the efficient market hypothesis is heavily debated in finance. I don't know to what extent it applies, but if you have an opinion on the efficient market hypothesis, do you think you can beat the market? Why or why not? Leave a comment. But the point is that you have to ask the question, do I really have an edge that will allow me to beat the market? Hedge funds and Wall Street banks with some of the best minds in the world can hardly figure out how to beat the market. It's very hard to beat the market consistently over long periods of time. For every buyer, there is a seller. Someone wins and someone loses. You have to believe you're superior to the other people you're trading against. You're buying a stock at $100 a share, which means someone else is selling at $100 a share. Are you really superior to that guy? How much time and research have you put in? You're competing with the entire world, and it's very difficult to beat the market. The S&P 500 returned an average of 10% a year from 1985 to 2015. At this rate, your money doubles every 7 years. If you invested $50,000 originally, you'd have made $940,000 by 2015. The average investor made only 3.6% a year for those 3 decades. At that rate, your money doubles only every 20 years, so you'd end up with only $146,000. So why not just buy the index? The history of the index fund is also pretty interesting. Jack Bogle was the founder of Vanguard and inventor of the index fund. And believe me, it was not an easy path for him. Wall Street smeared index funds for 3 decades. They said, we don't settle for average, we're all above average. Jack Bogle fought the establishment the entire way and made index funds what they are today. But given that index funds play such a prominent role in finance today, Jack Bogle must be worth billions, right? Or at least a couple $100 million. Actually, no. While him and his family are very well off, they're not billionaires. But in this world, where Mark Zuckerberg is worth over $100 billion for inventing Facebook, this thing we're not even sure if it's a net good for society. Well, Jack Bogle invented the low-cost index fund. And here's what Warren Buffett had to say about Jack Bogle. If a statue is ever erected for a person who has done the most for the average investor, the hands-down choice would be Jack Bogle. Index funds are great for the average investor, and Jack Bogle is a hero. Warren Buffett also had some things to say about the search for superior investment advice. Warren Buffett knew that almost all active managers underperform index funds in the long run. In 2008, he made a $1 million bet with a firm, and the firm selected the top 5 hedge fund managers who could collectively beat the S&P 500 over 10 years. After 8 years, the hedge funds were up 21%, and the S&P 500 was up 65%. The search by the elite for superior investment advice has caused it to waste over $100 billion in the past decade. The money Buffett leaves for his wife will be invested in low-cost indexes. The returns are far better than anything with a fee. So before you invest in a mutual fund, remember that index funds perform better and have lower fees. Financial services is a tax on smart people who don't realize their propensity for doing stupid things. Let me know whether you agree or disagree in the comments. And please show your support by liking and subscribing, and thanks for watching.